Welcome to the Deep Dive, where we try to cut through the noise and find some clarity.
Glad to be here.
Today, we're really getting into the whole world of market behavior. Specifically, how our own feelings, fear and greed, basically run the show on Wall Street.
And in our own investment accounts, which is key.
Absolutely. So the big question we're tackling today, looking at our sources, is this. How do we stay rational? How do we keep our heads when the market just goes haywire, swinging, from crazy highs to total panic?
It's a central challenge, isn't it?
It really is. Okay, let's unpack this. Our guides for this journey are, well, two absolute giants of investing thought. I've got John C. Bogle's Common Sense on Mutual Funds and Benjamin Graham's The Intelligent Investor.
Classics. Real foundational tests.
Totally. And our mission, really, is to pull out the timeless wisdom from these books. We want to arm you with the insights you need to handle that market roller coaster, that up and down, and hopefully sidestep the emotional traps everyone seems to fall into.
Yeah, and what's fascinating here is when you boil it down, understanding the market means understanding people, human behavior.
Right.
Graham saw this decades ago. It was incredibly insightful. He argued the market isn't some precise scientific thing.
No, not at all.
He saw it more like a giant pendulum, always swinging back and forth.
Between what?
Between what he called unsustainable optimism, that's when prices get way, way ahead of any real value, and then unjustified pessimism.
The fear part.
Exactly. When fear takes over and prices get pushed down to, frankly, absurdly cheap levels.
The smart investor.
The intelligent investor, as Graham put it, is a realist. They see this swing, they understand it, and crucially, they act against the crowd.
So selling when everyone's euphoric.
Selling to the optimists, yeah. And buying when everyone else is panicking. Buying from the pessimists.
That idea, acting against the emotional current, really brings us to one of Graham's most important points, doesn't it?
Absolutely. The big difference he drew between investment and speculation.
He really hammers this home. An investment, he says, is about actually owning a piece of a business.
An ownership interest in an actual business, yeah.
And the key thing is, its real value doesn't just depend on the stock price ticker going up and down. It's about the company itself.
Yeah.
Assets, earnings, that sort of thing.
Precisely. That's the bedrock. And then on the other side, you've got speculation.
Which is all about
mostly just focusing on those price movements, trying to guess what the market's going to do next.
like forecasting.
Yeah, or just, jumping in after a big drop, hoping for a quick bounce to sell.
And Bogle had a strong warning about this, too.
He did. Very direct. Impulse is your enemy.
Simple but powerful.
He saw how all that rapid trading, those short-term plays, they're almost always driven by emotion, not logic.
And they just don't work for building long-term wealth.
They're counterproductive. Graham was just as blunt. He said, never buy a stock because it has gone up or sell one because it has gone down.
So ignore the recent price action.
Focus on the value. He talked about the folly of the new era theory. You see this pop up in bubbles all the time.
What's that exactly?
It's this dangerous idea that suddenly the old rules don't apply, that a stock is desirable no matter the price, just because it's, new or disruptive or whatever the buzzword is.
Ignoring the actual price tag.
Completely. As if value doesn't matter anymore. And of course, it always leads to a crash. Always.
Which, I guess this raises an important question.
Definitely.
Have we actually learned anything? I mean, as investors.
It's a really good question. Because when you look at the data on investor behavior, it's kind of sobering.
You mean like how often people trade their funds?
Exactly. Look at mutual fund turnover rates. Back in the 60s, 70s, the annual turnover people selling their fund shares was about 8%.
Okay, so that means they held on for what?
Roughly 12 and a half years on average, a long-term mindset.
And now?
Fast forward to recent times, that rate jumped to 31% annually.
Wow. So the average holding period?
Plummeted down to only about 3 years.
3 years. That's a massive shift toward short-term thinking.
It really is. And it's not just the individuals holding the funds. The portfolio managers themselves. It seems like they caught the bug, too.
From the people investing in their funds.
Or just the general market environment. In 1997, get this, the average U.S. equity fund turned over its portfolio at a rate of 85%.
85%. Annually.
Annually. Basically replacing almost their entire portfolio every single year.
That sounds more like day trading than long-term investing.
It does. And all this churning, this frantic activity, it's not just stressful.
It costs money. A lot of money.
Bingo. Beyond the obvious trading fees, there's what Bogle called the tyranny of compounding costs, a silent killer of returns.
Yeah, it's easy to overlook that, isn't it? You see an expense ratio, maybe 1%, 1.5%,
And you think, does a point or so really matter?
right? Seems small.
Oh, but it's huge. It matters profoundly.
Hmm.
Bogle showed how these small fees and the hidden costs of trading just eat away at your wealth.
How much are we talking?
Well, for actively managed funds, you've got the expense ratio, say average 1.5%, then add maybe another 0.5%, even 1% in hidden transaction costs from all that turnover.
Okay.
Bogle estimated those costs can easily gobble up almost 1/3 of a 10% annual return.
1/3. Just gone.
Vanished. Before you even think about taxes. And it compounds. It gets worse over time.
That's the tyranny part.
Exactly. Bogle's tyranny of compounding. A small difference in cost creates a massive gap later on.
Can you give an example?
Sure. Let's say you invest $10,000. Over 15 years, in a kind of okay market, maybe a low-cost index fund gets you close to an 8% net return. That $10 tag grows to, say, $31,000. But the higher-cost managed fund, maybe it only nets you 6% after costs. Your $10 only grows to $24,000.
That's $7,000 less, just from costs.
Over 20% less wealth, yeah. And over longer periods, it's devastating.
Here's where it gets really interesting. Or maybe depressing.
Yeah. Take 40 years. Imagine the market gives you 12% a year, but your high-cost fund only gives you 8% after costs and taxes.
Which sounds plausible.
Very. Well, you'd end up with only about 23% of the money you could have had.
23%.
Yeah. Instead of maybe $931,000 from the market potential, you end up with just $217,000. All that difference, eaten by costs.
Wow. That's staggering. And you mentioned taxes earlier.
Right. Bogle called taxes the other black sheep of the industry.
Why black sheep?
Because managers love to show you pre-tax returns, but you, the investor, you pay the taxes.
And all that trading generates taxes.
Constantly. High turnover funds often trigger lots of capital gains distributions, which you owe taxes on year after year, further reducing your real return.
Okay, so emotion is the enemy, impulse is the enemy, and these hidden compounding costs are just silently destroying potential wealth.
That's a pretty good summary.
So what's the answer? What's the rational way forward, according to Bogle?
Well, he kept it incredibly simple. 3 basic rules for long-term success.
Okay, what are they?
Rule 1, invest you must. Don't sit on the sidelines. The biggest risk isn't market ups and downs. It's not being invested at all over the long run, earning nothing. Or worse, losing to inflation.
Makes sense. Rule 2.
Time is your friend. Start early, even small amounts. Let compound interest do its thing. It really is like magic over decades.
The 8th wonder of the world.
Something like that. And rule 3 ties back to our earlier points. Impulse is your enemy.
Eliminate emotion.
Exactly. Have rational expectations. Don't chase fads. Don't panic sell. Stick to your plan.
And these simple rules, they point towards indexing.
They lead directly to it.
Yeah.
The power of indexing.
It's funny, when Vanguard launched the first S&P 500 index fund back in '75,
Oh, yeah, people mocked it.
Bogle's folly, they called it, said it was doomed to mediocrity.
An absurd idea, apparently. How could just matching the market possibly be good?
But today, it's like the gold standard for smart investing for most people. Why the turnaround?
Because it works. Index funds don't try to beat the market. They just aim to be the market, minus tiny costs. And that simple goal gives you huge advantages.
At lower costs, obviously.
Way lower costs, much better tax efficiency because they don't trade much. And lower risk, you own the whole market, not just a few potentially risky bets.
And the performance. How did Bogle's folly actually do?
The results are just, well, stunning. That original Vanguard fund, it beat 94% of its competitors before taxes over 15 years.
94%.
And after taxes, it beat 97%.
Wow. So much for mediocrity.
Right. Over 50 years, index funds basically captured 99% of the market's return. Actively managed funds, especially balanced ones, captured way less, maybe only 70-something% in some studies.
And that temptation to chase the hot fund manager, the one with great recent returns.
Forget it. Past performance is not predictive. There's a strong tendency called reversion to the mean.
Meaning the winners fall back.
Yeah, today's top funds are often tomorrow's average or even below average funds. They rarely stay on top for long. The S&P 500 index just keeps grinding along. So if we connect this to the bigger picture, what does it all mean?
It sounds like trying to pick stocks or find the genius manager is, for most of us, probably a losing game.
For the vast majority, yes. Maybe a tiny handful of truly dedicated, brilliant investors can do it consistently. A Warren Buffett.
But for the rest of us, mere mortals,
Broad diversification through low-cost index funds is absolutely the way to go. It's essential.
and even the pros agree.
Many of them do. Peter Lynch, famous active manager, said flat out most investors would be better off in an index fund.
That's telling.
And Charles Schwab, whose company makes money from active trading, even he said something like only 1 in 4 equity funds beats the market. That's why I'm a firm believer in the power of indexing.
So it comes back to avoiding the emotional swings and the cost drain,
And that leads us right back to Graham's core message, his enduring wisdom.
which was about
Protection. He stressed investing on the basis of protection. Protection from what?
from paying too much, I guess.
Exactly. Protection from overpaying for a stock. And just as importantly, protection from being overconfident in your own judgment.
Humility.
Definitely. Because the future, it's uncertain. Trying to forecast it, Graham said, is basically a fool's errand. Better to focus on what you can control, the price you pay, the costs you incur, your own behavior.
And those market prices flashing on the screen.
Graham had a great line about that. Market quotations are there for your convenience.
Convenience. How so?
They're there for you to potentially take advantage of if they offer a bargain based on your analysis of value, or you can just ignore them.
You don't have to react.
Absolutely not. They shouldn't dictate your emotions. They're a tool, not your boss. Use them or ignore them.
So what does this all mean? Tying it all together for someone listening.
Well, it means that whole market roller coaster, the wild ups and downs, it's largely driven by us, like human emotion, fear and greed.
Primal forces.
Totally. And the path to actually succeeding long-term isn't about being smarter than everyone else or predicting the future. It's not about genius.
It's about discipline.
Discipline, rationality. Following the kind of timeless advice Graham gave focus on value, demand a margin of safety. And combining that with the practical, powerful strategy Bogle championed, low-cost, diversified indexing.
Be a realist, not a speculator or a forecaster.
That's the essence of it. Control your emotions, control your cost, and let the market work for you over time.
Powerful message.
And maybe a final thought for listeners. How can you apply these ideas beyond just your stocks? This skepticism towards hype, this focus on real value, this awareness of hidden costs.
Where else does that apply?
Right. Think about other areas where maybe new era thinking or high costs, maybe not financial costs, but costs in time, energy, health might be leading you astray from, well, common sense.
That idea of the tyranny of compounding costs could apply to bad habits, wasted time.
Exactly. How do small, seemingly insignificant drains add up over the long haul in other parts of your life? Something to chew on, maybe, as you do your own deep dives.